Velocity banking is a strategy where you use a line of credit as your primary account and use lump sums to pay off a loan, usually a mortgage. The whole idea behind velocity banking is that a line of credit will help you use cash flow and extra money to cover your expenses, but also go towards paying off your mortgage. The strategy usually utilizes a home equity line of credit, called a HELOC, and the HELOC functions as your primary expense account instead of a regular checking account. The HELOC eliminates the need for a savings account since all your free cash flow will be going towards the mortgage. People who use velocity banking believe it will allow them to pay off their mortgages faster and with less interest. Take a look at this example. John and Sarah have a mortgage of $100,000 at 5% APR. They also have an income of $4,000 per month, and they spend $3,000 each month on miscellaneous expenses, including their mortgage payment. This leaves them $1,000 of discretionary cash flow per month. John and Sarah have decided to use the velocity banking strategy, so they open a HELOC with a credit limit of $25,000 at 5% APR, and this is based on their appraised home value of $125,000. Following the velocity banking strategy, John and Sarah make a payment from their HELOC to pay their mortgage. They could make a lump sum payment of $25,000 since that's the value of the HELOC, but it's wise to keep a reserve, and so they decide to only draw $12,000. With the $12,000 payment, their mortgage balance is reduced from $100,000 to $88,000, and their outstanding HELOC balance is $12,000. Next, John and Sarah take their monthly income of $4,000 and make a payment on the HELOC. So now the outstanding balance on the HELOC goes down to $8,000. John and Sarah use a credit card to pay for their monthly living expenses. At the end of the month, they draw $3,000 from the HELOC to pay off the credit card and to make their monthly mortgage payment. This increases the outstanding balance on the HELOC to $11,000 plus some interest. Next month, John and Sarah put their paycheck toward the HELOC at the beginning of the month and pay monthly living expenses and the mortgage payment from the HELOC at the end of the month. This is called paycheck parking. Continuing this process, the outstanding balance on their HELOC is reduced by about $1,000 minus interest each month. After 9 months, John and Sarah's outstanding HELOC balance is only $4,000, so they can make another lump sum payment of $12,000 from the HELOC to their mortgage. After this payment, the mortgage balance becomes $74,442, and the outstanding balance on the HELOC is $15,154. Following the velocity banking strategy, John and Sarah have paid off 10.4% of their total mortgage and HELOC in only 9 months. If they continue this process, they will pay off their entire mortgage and HELOC in 6 years and 4 months. If they had simply made an extra payment of $1,000 per month to their mortgage without utilizing the velocity banking and paycheck parking strategies, it would have taken them 6 years and 5 months to pay off their entire mortgage. This gives the velocity banking strategy an advantage of 1 month and $1,458 of interest saved. From this example, we can see why velocity banking sounds very appealing on the surface. But although the strategy might work out on paper, there are many factors which can change actual results along the way. Let's take a look at a few of the underlying assumptions and the problems associated with those assumptions that can make the whole velocity banking strategy fall apart and leave you with more financial burdens than you intended. The first assumption is that paying off your mortgage early is the best financial decision. Velocity banking relies on the assumption that you need to pay off your mortgage as quickly as possible while using all of your available funds to do so. This may sound counterintuitive, but you might not want to pay off your mortgage as quickly as possible. Your home is often your most effective liability, and it isn't necessarily bad to have a mortgage on it. Instead, it's more financially savvy to continue making mortgage payments while using some of your free cash flow to build for your future. This could be cash value in whole life insurance, making investments, or growing your savings in other ways. The second assumption is that saving on interest payments is the most important factor in paying off your mortgage. Velocity banking also relies on the assumption that you need to save interest to truly benefit from paying off your mortgage early. While interest payments can add up and be a hassle, they aren't always the most important factor. When you get caught up on saving interest, it can be easy to forget that you're using all of your free cash flow towards that purpose. While paying off liabilities does result in lower interest payments, it could also result in lost opportunity costs because you are using all of your free cash flow. The third assumption is that equity in your house counts as savings, and the HELOC will tap into that savings best. Although velocity banking can help increase your home equity, that equity does not equate to savings because you might not always be able to access it. The problem here is that for money to truly count as savings, it must have maximum liquidity and safety. You must be able to access the cash reliably and quickly for it to serve you well when you need it. So even though you may increase your home equity, you aren't actually increasing the money you can access and use. For velocity banking to be successful, it needs all three of the assumptions just covered to hold true. For some people, velocity banking may help and be in line with their financial goals, but for those who want to save for retirement, want the security of a life insurance death benefit, or want to utilize the life insurance cash value, velocity banking is not the best strategy. One of the major challenges with velocity banking is lack of security. The strategy may fall through for a variety of reasons. For example, if the interest rate on your HELOC changes, if the housing market drops and lowers your credit access, if the bank freezes your line of credit, or even if your cash flow changes, you may find the numbers don't work out. And even worse, you may find out that you've missed out on several crucial years of saving for the future while you pay off your mortgage. This is where whole life insurance comes in. You may have heard of the infinite banking principle, but this strategy can go by many names. This strategy involves using a participating whole life insurance policy to accumulate cash value while also having the security of a death benefit to help your family should you need it. Where velocity banking fails, whole life insurance thrives. Whole life insurance provides the security of maximum liquidity and safety for your cash value, which means you can access it at any time for anything, both now and in the future. The main appeal of using life insurance instead of velocity banking is control. With life insurance, you have complete control of your cash flow. With velocity banking, you don't. At Life Benefits, we design and sell life insurance that will provide you the liquidity and safety you need. Contact our office and schedule a consultation so we can help you. Hey guys, thanks for watching this video. If you enjoyed it, please give it a thumbs up. Also click the subscribe button to enjoy the latest content and newest videos on the channel.